If I can find my mouse. Okay, somebody mentioned we had a weird thing happening earlier. I don't know what it was, but some of the numbers were popping up like they were crossed out or something. I don't know what that is. It's never happened before. So we'll just give it a shot and hope that it's working correctly. All right, 5 questions. You should put away your notes at this point and any other device that's not what you're doing the quiz on. All right, here we go. Question number 1. The debit side is which side of the T account in English? Is it the left side or the right side? You guys were doing your accounting calisthenics last time, so hopefully you got this down. Okay, good. All right, so debit means left, credit means right.
Sorry, I'm not sure about that.
That was Siri. An increase in accounts payable should be recorded on which side of the account? Accounts payable. Accounts payable is a liability, so think about it for a second. Shouldn't be talking during this. This is up to you. So accounts payable is a liability. So if you think of your teeter-totter diagram, it increases on the credit side. All right, question 3. What is a trial balance? Trial balance. Is it a practice financial statement for new employees? Is it a listing of account balances with debit and credit columns? Is it an assortment of T accounts, or is it another name for the income statement? What is a trial balance? We talked about the accounting cycle last time, and we talked about different trial balances you'd prepare at least 3 different times. So what are trial balances? Okay, so trial balance, after you've made entries, you want to make sure you didn't mess up your debits and credits. You're simply going to list the accounts out with their balance, either in the debit column or the credit column. And when you get to the bottom, the debits should equal credits. So it's just a way of checking to make sure you've done your work correctly. Question number 4, true or false? No account appears in both the income statement and the balance sheet. True or false? All right, that one is true. They're either on the income statement or the balance sheet, but you'll never have the same account appearing on both. There is one oddball account, which was dividends, which appears on neither the income statement nor the balance sheet. It only appears in the statement of retained earnings. Okay, last one I think was a little weird. I'm trying to remember what the question was. Let's read it carefully here. It says, beginning retained earnings is 1,000 and net income is 500. No dividends are paid. What is ending retained earnings? Sorry, we have a limited number of characters we can put into these questions, so that's my abbreviations. So beginning retained earnings is 1,000. Net income is 500. No dividends are paid. So what is the ending balance in retained earnings? All right, good job. So the formula is beginning balance retained earnings plus net income minus any dividends equals your ending balance, right? So in this case, since there were no dividends, it's just beginning balance plus net income, which gives us 1,500. All right, most of the time we won't ask you to do calculations, but we figured this was simple enough you could do it in your head without a spreadsheet or anything like that. All right. So we have you sitting today in your groups again, just to make sure you've all met. I've had several people email me and say that there's some rogue member of their group that's never showed up for class, never responded to an email or anything like that. So all I can say at this point is do your best to reach out to them. If they don't participate, then all you can do is when you do the evaluation, you'll just have to give them a 0 because they didn't participate, right? Hopefully you're all working together. All right, so just a quick review. Today at midnight, the first part of the group project, part A, will be due. And so I'm trying to think of some of the questions I've had. So for example, I can't remember, but the income statement from last year may have had more revenues and expenses than this year's. It's okay if you don't have the exact same expenses and revenues in a particular year, right? Each year is going to be unique. You're going to have different transactions, so there's no problem with that. Let's see. Any other questions about the project before we get started? Just got your name. Alex.
When I try to save the project, it says that it was done in 2007 Excel. Some functions might not work.
Okay, so.
Is it okay if I save it and then send it in?
Yeah. So for example, if I don't remember what version of Excel we were using when we made the original version of this. So if it's made in an older version and you're using, say, Excel 2016 or something, then that's fine. You can just save it in whatever version you're using and we should be fine. All right, remember that only one person from your group is going to so there may have been 5 people in your group working on it, but you have to choose somebody to be the person to submit it. Okay, so we don't want to get 5 copies from each group, just one is plenty. All right, any other questions? All right, so you are sitting together again today as your group. After this, we're going to go back to randomizing you, so just make sure you know who everybody is in your group, because a week from today, Part B is going to be due. And so Part B is taking the exact same transactions, and you're just going to now convert it into debits and credits, make journal entries, post it to the T accounts in the ledger, and prepare your trial balance and financial statements. So we'll practice that today. That's kind of what the purpose of today is. So our agenda is, first of all, we're going to play Name That Company again. Hope y'all liked that last week. Last time we played Name That Company related to the balance sheet accounts, and today we're going to play Name That Company again, but this time related to the income statement. We're going to talk more about the differences between income, what happens on your income statement, and cash flows. I think that's going to be a useful exercise. And then at the end, we're going to practice accrual accounting, and so hopefully you'll feel pretty confident. Really, pretty much everything we will cover by today is what you need to know for Part B of the group project, which is due in a week. So you can do it, knock it out this weekend very easily. In fact, tomorrow, what I will do, so by midnight tonight, you turn in your transaction analysis, Part A. I will post the solution, so if you missed 1 or 2 points, it's not a big deal. You'll know what the correct answer is, and then just use that correct answer then to go forward with Part B. Okay, so you could knock it out tomorrow if you want to get together with your group on Friday, and then you're basically done. You can turn it in anytime you want. All right, so let's jump into this. Name that company. Now, before I do the first one, you've got the questions there at the top of the page. Before you... just want to check something here. Before we start the first one, I want to make sure you know what type of companies these are. Okay, so Travelers Insurance, I think you can tell by the name. It's an insurance company. No problem there. The next one, Alcoa. Does anybody know what Alcoa manufactures? Yes. Steel, aluminum, kind of metal type products. That's exactly right. And 3M. Does anybody know what they do? Who said it? What is it? Tape, that's one of them. All kinds of office supplies, right? So you've probably seen 3M, like Scotch tape or whatever. So exactly, all kinds of office supplies. If you ever go into like Office Depot or something like that, you'll see tons of products from 3M. And Toys R Us, I think you probably all know what that is, right? Okay, so this first one says, my total revenue for the year, ended January 31st, 2017, was $11.5 billion. I generated 40.5% of this revenue in the 3 months of November, December, and January. So which company am I? Talk about it.
They didn't happen to my friend last night, but like in any case where we're doing our homework and like
for some reason like the page shuts down or something, or it gets submitted on accident, should we just like send you an email and explain it?
Yeah, send it to my TA, LaShandra. She can fix it real quick for you.
Thank you.
All right, guys. So the point of this question is, if you're a typical company and you kind of have sort of a normal business, you're probably going to earn about 25% of your revenues every single quarter, right? So this company is kind of different because they're earning a huge kind of a disproportionate share of their revenues in one particular quarter. So knowing what you know about the insurance industry, is that likely to be them? How about Alcoa? They produce metals and things, right? Do you think it's them? How about 3M? They probably make as many office supplies in the first quarter as they make in the third or fourth quarter, right? So who do you think it is? Toys R Us. And why would it be Toys R Us? Yeah, because the holidays, right? The end of the season is when parents buy a lot of toys for their kids, and so they tend to have a higher share of their revenues being earned in the fourth quarter. Now, I just want to give you a little follow-up on this. You guys grew up with Toys R Us, right? Whoever went to Toys R Us as a kid? You're just kind of walking around dreaming about all the toys and everything. So what happened to Toys R Us recently? Bankruptcy. Was that like a blow to you because like a big part of your childhood was kind of going away? So in 2017, they filed for bankruptcy protection. During last year, 2018, they pretty much closed all of their U.S. stores. But there's a ray of hope. In October, they put out a press release saying they're hoping to reopen some retail operations in the future. So maybe, just maybe, when you guys have kids, there will still be a Toys R Us around. We will see. All right, next one. Cost of goods sold. So cost of goods sold, this company says, is by far my largest expense. For the year ended January 28, 2018, my cost of goods sold of $66.5 billion was 66% of my sales of $100.9 billion. Am I Home Depot, Google, American Express, or Disney? Talk about it. All right, guys. I don't want to make them too easy for you because sometimes everybody knows exactly what it is, right? I'm hoping this one's going to generate a little more disagreement among you. So how many of you think this one might be Home Depot? Okay, good number of you. How many think it might be Google? Not a lot of takers. American Express? How about Walt Disney? Okay, this one tends to get more people thinking about it. So why is it not Google or American Express? No inventory, right? So if you're Google, you're sort of an internet service provider, so they don't really have a lot of products. American Express, I mean like a credit card financial institution, right? So they don't have a lot of products. So it's either Home Depot or Walt Disney. Now, what kind of products does Walt Disney sell? Tickets to their amusement parks. What else? T-shirts and other kind of like character action figures, toys, things like that. They also sell a lot of movies, right? So they have inventory. So in order to have cost of goods sold, you got to sell inventory, right? So it could be them. Those of you who said Home Depot, why would you choose Home Depot over Walt Disney if you're trying to just look at these two companies? Why do you think they would have more cost of goods sold? More expensive stuff, and what else? The sheer size, right? So Home Depot's huge. If you're going to, we talked about this last time. Every time you walk into a Home Depot store, it's like 2 or 3 acres of floor space, and it's stacked 30 feet high with inventory, right? And there are a lot of Home Depot stores out there. Pretty much every town has a Home Depot store. So it turns out just to get to this sheer size, if you're talking about $100.9 billion in sales, you got to be pretty big, right? Disney's big, but a lot of what they do is more entertainment type stuff as opposed to just selling products. And so in this case, it actually is Home Depot. All right. Next one, depreciation. So first of all, before we give you the scenario, what is depreciation? We've mentioned it a couple of times. It's an expense, right? And it's related to what kind of assets? It's long-term assets, right? Like property, plant, and equipment, machinery, trucks, buildings, things like that. Okay, so let me just give you a little scenario here. I put an example on the board. My question, I'm going to give you two scenarios here. Which is more representative of actual performance if you're trying to measure the company's performance? So let's say a company buys a machine for $10,000 and they anticipate this machine is going to last them about 5 years, right? So on average that would be, if you divide by 5 years, about $2,000 per year. Is it more descriptive of the company's performance to say, well, we earned revenues of $3,000. That's the year we bought the machine, so we're going to expense the whole machine this year, $10,000, and show a net loss for this year. Then all future years will just show revenues but no expenses, so income, profit, 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 and in total profit, right? Total revenues of $15,000 minus $10,000 the cost of the machine equals $5,000 in profits. Is that more descriptive, or this one over here where we take the cost of the machine and divide it up over the years and just allocate that cost over the life of the asset? So we say $3,000 in revenues in year one, depreciation expense of $2,000, profit of $1,000, and just show that same kind of performance every single year. In total, you get the same numbers, right? Which one is probably more representative of how the company's performing? Does that machine benefit more than 1 year? Does it make sense to expense it all in 1 year, the year we bought it? Not really. If it's going to benefit us over a longer period of time, it kind of makes sense you might want to allocate that cost over time. That's the purpose or the idea behind depreciation. We're going to take the cost of those long-term assets and just sort of allocate it out over the period that we receive a benefit. Now, we don't use this term all the time, but it's sort of doing what? It's sort of matching the expense that we've incurred, depreciation expense, with the revenues that machine is helping us to generate, right? That's kind of the idea of what's going on here. All right, so going back to this scenario here, this company says my depreciation for 2012 totaled $5.9 billion. This is down substantially from prior years. For example, my depreciation in 2005 was $15.8 billion. Now, I'm expecting you to know a little bit about the company here, but am I Google, Microsoft, General Motors, or Berkshire Hathaway? Talk about it. All right, guys, I picked some years a while back because something kind of dramatic happened to this particular company here. So first of all, Microsoft, we've talked about Google before, internet service provider, right? What about Microsoft? What do they sell? Mainly software. They have some products they sell as well. General Motors, what do they sell? Cars. And Berkshire Hathaway, what kind of company is that? Okay, I heard a lot of different answers. You're all right. Berkshire Hathaway is a huge investment company. They own all kinds of other companies. Okay, now if you took all of their companies and lined them up, the vast majority of them would be actually insurance companies. They own companies like Geico and some other companies you've heard of, but they also own all kinds of other companies as well. All right, so they're just kind of a big investment company. They're a holding company that they hold a lot of the stock of other companies, right? Okay, so which one of these companies do you think would have a huge change so where their assets would actually be down? Usually companies are growing over time, right? Which company here you think might have actually gone down in terms of the big total assets that they're depreciating? Who? General Motors. Why General Motors? That's actually the right answer. What happened to General Motors? You guys are kind of young to remember this, but did we have a, what was it, Zach? They got bailed out because there was a huge financial crisis, right? And in that financial crisis, people stopped buying cars, and a lot of these big companies, the U.S. automakers, were in huge trouble because they had all these fixed expenses that they were stuck into paying, and they weren't generating any revenues from selling new cars. So it was the government that eventually bailed them out so they didn't go bankrupt, right? Okay, so I actually lived in near Detroit in about the year 2013 when a lot of this was happening. So they had to sell off a huge portion, a lot of their assets were sold off, right? In fact, if you look at the city of Detroit, they had like a ghost town there because people just left. People that used to work in manufacturing left, and General Motors had to sell out. General Motors, Ford not as much, Chrysler, they sold off lots of assets during that time period. So what they used to be depreciating became a substantially smaller pie, and so the depreciation expense went down significantly, right? So it's about a third of what they had in depreciation expense just a few years earlier. All right, next one. Bad debt expense. First of all, what is bad debt expense? You go look at the words. Bad debt. And it's an expense. So this is when people owe you money. So you're expecting that you're going to collect it in the future. And all of a sudden they say, sorry, we're not going to pay you. We're going bankrupt, or we're just moving out of town, or whatever. So when people who owe you money decide not to pay you, then you got to write that off, right? And so that's what we call bad debt expense. So this company says, my bad debt expense for each of the past 4 years has been as follows. 2017, $2.5 million. 2016, $3.77 million. 2015, $2.44 million. And 2014, $1.4 million. Am I Wells Fargo, McDonald's, Walt Disney, or Walmart? Talk about it. All right, so this is kind of a tough one. At least some people find it to be tough. By show of hands, how many think it might be Wells Fargo? Quite a few of you. All right, how about McDonald's? No takers there. Walt Disney? And Walmart. Okay, so let me ask you about, so in order to have someone owe you money, you have to sell something to them or provide a service on credit, right? So when you walk into McDonald's, you say, I'd like a Big Mac and a large shake and some fries, and put that on my tab. I'll pay you later. Has anybody ever done that at McDonald's? No, probably not. And Walmart, you're walking out, you say you got a big cart full of groceries and stuff, and they ring it all up, and you say, that's good. Put that on my tab. Okay, well, they actually do have layaway. Okay, so that's possible. Now, and I will say it is possible, but probably not to the tune of $3.77 million, right? Okay, so this one is actually Wells Fargo. Okay, Wells Fargo is a bank. So what happens? They lend people money. That's how they earn money. They earn interest income, right? And so if people stop paying on their loans, then they're going to have to write that off. They're going to have bad debt expense. All right, so that's the idea. Okay, this next one, I need to sort of give you some terminology. A lot of times you'll hear people talk about how profitable a company is, and they'll say, what's your return on sales? Or another term for that, what's your profit margin? So you're basically taking your net income from the bottom of the income statement and dividing it by sales at the top of the income statement. Or another way of saying that is, if your sales number is 100%, that's the total sales you brought in, what percentage of that trickles down to the very bottom of your income statement and survives as profit after you've covered all of your expenses? Right? So that's your profit margin. What percentage of your sales makes it down to profit, net income at the bottom of the income statement? All right, so I'm going to give you two different scenarios that focus on this idea of profitability. Okay, the first one says, in 2016, my return on sales was 3.6%, which was much lower than any of the other three companies listed below, all with return on sales of 21% or more. Who am I? Talk about it. All right, this is actually a really hard one because it requires you to know something about the profitability in different industries, right? Because these are different industries and they're very, very different types of companies. So it all has to do, who's had an econ class? You've had econ? Supply and demand. You got your supply and demand curves, right? So you have to come up with some equilibrium price that you can charge. And so if you're in sort of a monopolistic sort of setting, you can charge whatever price you want. If there's high competition, it's going to drive those prices down. You got to stay competitive with everybody else, right? So think about these three companies here and think about which one of them is in an industry that probably has the highest level of competition. Any ideas? Who do you think this company might be? ExxonMobil? Okay, you're actually right. Now, the reason I threw this in here, this is actually a trick question. If I ask you which one is has the highest total profits, in many, many years, ExxonMobil has been the most profitable company in the United States. In terms of total dollars, they're huge, right? But their cost of goods sold is also huge, right? So their margin, how much profit they make on each barrel of oil they sell or whatever, is actually smaller because there's competition from BP and these other companies that are out there. Okay, so it turns out that Apple, Google, and Microsoft are in their industries are much more, there's less competition for them. They actually have a really commanding kind of position in their industries, and they have much higher. So if you think about it, they're earning 21% or more in profits, whereas ExxonMobil's down around 3 or 4%. Okay, so keep that thought in mind because I'm going to give you a similar question now, different set of industries. Okay, so this one, it says low return on sales. It says in 2016, my return on sales was 1.9%, which was the lowest of any of the four companies listed below. Who do you think it is? Talk about it. All right, guys, let's talk about it. This one's a tough one. I'm just going to have you guys vote and see where it comes out here. How many think it might be Kroger? Okay, good number of you. How about Coca-Cola? McDonald's, anybody? And Boeing. Okay, that was like the most even split I've ever seen. Good job, guys. All right, so you could make a case for why some of these industries might be very, very competitive because that's a pretty low profit margin, right? 1.9%. In the last one, ExxonMobil, we said was 3.4%, right? So it's less profitable than even ExxonMobil. And so the question is, which of these industries is going to be the most competitive? So McDonald's, who are their competitors? Burger King, Wendy's, other fast food types of fast food, right? So competitive there. What about Coca-Cola? Who are their competitors? Pepsi. There are other soft drink companies out there, actually. Dr. Pepper is a separate company. We're actually going to do them at the end of the semester. All right, Boeing, they make airplanes. Who do they compete with? Lockheed Martin, Airbus. There's some Embraer is a Brazilian company, so they have some competition there. Well, it turns out the most cutthroat industry up here happens to be groceries. And I'll tell you who's made it even worse. It's Walmart. Walmart used to sell other types of products, and 10, 15 years ago, they decided to get into groceries. And so they're so huge that they can survive on very, very small profit margins. So they're making up the difference with volume, right? You're making a small profit on each product you sell, but you're selling lots and lots and lots of product. And so that's how they survive. Kroger, man, they have to operate on a very thin margin. They're not making a whole lot. They're making pennies on the dollar, right? They're making less than 2 cents on every dollar they sell. And so in order to stay profitable, pay all their employees and, just kind of maintain their buildings and everything, they've got to sell a lot of groceries. All right, so hopefully you'll learn more about businesses as we go along. All right, we're going to just quickly review this is the book's way of presenting debits and credits. So if you looked in the book, you saw these diagrams. I'm still a huge fan of my teeter-totter diagram.
The other thing you said.
Sorry. Just don't say, she who must not be named. She keeps thinking I'm saying her name, I guess. Anyway, so the teeter-totter diagram actually for me is a good way to remember. If you prefer these, that's fine. But you just have to remember which type of accounts are increased by putting the number on the debit side and which type of accounts are increased by putting the number on the credit side, right? Okay, guys, you got to practice this. We're only about a little over 2 weeks away from our first midterm. This is the bread and butter of that midterm. You have to know how to analyze transactions and convert it into accounting language, debits and credits. All right, so you had 2 homework problems today. The first one was 2-6B. The one thing I will mention about this one, almost every one of these transactions involves, what word do you see up here all the time? Cash. So I'm going to go back over here. Cash is an asset. So we increase cash by putting the number on the debit side. We decrease cash by putting the number on the credit side, right? So this problem is actually pretty easy. You just have to say, I just always ask myself about the cash. Am I receiving cash? Debit. Am I paying cash? Credit, right? And once you know one side of the journal entry, the other is just going to be the opposite. So if you go through each of these transactions and you look for the words paid, borrowed, purchased, paid, you can kind of tell, is the cash coming in or out? And then it's easy to figure out the other side. Okay, so I'm not going to go through every one of the transactions with you, but it's good practice. This is what we're doing. First of all, for the part A of the project you're turning in tonight, it's just about analyzing the transaction. But next week, when you redo these same transactions, you have to be able to convert them into debits and credits and record them as journal entries. So for part B, that's due a week from today, you're going to take those same transactions that you've analyzed for your part A project, and you're going to convert them into journal entries and then post them to the T accounts in the ledger. So the second problem you had was 13A. This one is probably the closest to the group project of any problem. Okay, so you start here with an opening balance sheet. So that's the ending balance for last year, right? Last year's ending balances become what for this year? The beginning balances, right? So those are the beginning balances for this year. And so again, that's just your opening balances. Then you have a series of transactions. So how do you do it? You analyze each transaction. What accounts are affected? Are they increasing or decreasing? What's the dollar amount? Then you translate that into, using that diagram, right, into debits and credits. So you're going to record the journal entries. This one's, again, very similar. Almost every one of these transactions includes cash. So again, if cash is coming in, it goes on which side? Debit side. If cash is going out, it goes on which side of the account? Credit side, right? So again, very simple to analyze these transactions, record them as journal entries. Again, the general journal, records the transactions chronologically. So we can just kind of quickly go back and see how things happened chronologically. And then we're going to post these or copy them over to the ledger, right? The ledger is simply like a book of T accounts. And so that's what you've done here, is you post each of those transactions into the T accounts. And the ending balances in these T accounts is what you're going to use to prepare your financial statements. All right, so quickly then, if you look at these accounts, everything from cash all the way over to retained earnings, what kind of accounts are those? They're balance sheet accounts, right? So you simply take the ending balance in cash, the ending balance in accounts receivable, equipment, accounts payable, etc., and that's going to make your balance sheet. Now, these accounts over here, starting with dividends. Dividends is that weird account that only appears on what financial statement? Statement of retained earnings. Okay, so we're going to need that one for the statement of retained earnings. And then everything else, service fees, rent expense, salaries expense, delivery expense, advertising expense, utilities expense, supplies expense, those all go on the income statement, right? So the first financial statement we prepare is our income statement. So we're just going to take these accounts right here and prepare our income statement. Then we have to actually close those accounts out. So every account that's on the income statement is a temporary account. So for example, supplies expense has what kind of a balance? Is this debit or credit? It's a debit, right? So if I want to close this account out and make it zero, I'm going to put $22.60 on the credit side. right? Likewise, each one of these I'm going to make a credit for 350, credit for 600, credit for 400, credit for 4600, credit for 670. This revenue account up here has a debit balance, right? The debit balance is 17,700. So to close this account out, I'm going to have to make a debit for 17,700. Okay? So we're going to closing entries is one of the big things we need to learn for part 2 of the assignment. We're going to close those accounts out. Typically, we'll close them into a temporary account, another temporary account called income summary. If I close all my revenues and all my expenses into one account, what balance should I have in that account? It should be equal to my net income, right? Okay, so if I've calculated net income, then I'm going to close that account out to retained earnings, right? Because the income now belongs to the shareholders. And then I'm going to take dividends, which is also a temporary account, and close it out. So dividends has what kind of balance? Debit. So I'm going to make a credit to close it out. So I'm closing those accounts out into retained earnings. So now what balance would I get? This is my beginning balance in retained earnings, right? What answer am I going to get right here at the end of the period? It's my ending balance in retained earnings. So it's going to be beginning balance plus net income, all these accounts, minus dividends will give me my ending balance. That's what's going to show up in my final balance sheet at the end of the period. All right, so this problem has you take these ending balances, prepare a pre-closing trial balance, then we do our closing entries to close out all of the income statement accounts down here and dividends, and then we'll be left with a post-closing trial balance, which then shows up as our final balance sheet. Okay, so this problem, again, I'm just going to say this again, is a very good practice for preparation for what you're going to do next week on part B of the group project. Okay, I know it's kind of a hassle that I'm making you work together. The idea is everything that we've learned so far comes together in this one project, and that's all about the first exam. So I need you to actually work together, teach one another, so you feel prepared for that first midterm. All right, hang with me, guys. 2 more weeks, we'll be ready for the midterm. All right, now let's get ready. So if you go to your handout again, we're going to go through some additional exercises now. First day of class, I showed you my depiction of the financial statements and how they fit together. So let's kind of review it here. So we start off the period with a balance sheet, selfie. How do I balance out assets, liabilities, and equity as of January 1st? So that's my snapshot to start off the year. During the year, I'm going to calculate my income. So I have to...
0.87 miles, 1.4 kilometers.
Okay. There we go. Sorry. I wasn't talking to Siri. I don't know why she keeps voicing herself today. But we want to calculate our performance. So it's a video of our performance during the year. So from the beginning of the year, January 1, till the end of the year, 12/31, how did I perform? So let's take a video of how we did. Revenues minus expenses. Those are all the revenues I've earned during the period, minus all the expenses I've incurred. What's my net income, right? That's a measure of performance for the year. End of the year, I take another snapshot. How do I balance out at the end of the year? So ending cash and other assets, ending liabilities, ending equity accounts. This funnel over here is the statement of retained earnings. So I'm taking my net income for the period. It's going to funnel through the statement of retained earnings. Because remember, over here, I had beginning balance and retained earnings, right? In the equity section. So beginning balance plus my net income for the year, minus any dividends I paid, gives me the ending balance that shows up at the end of the year balance sheet, right? Last financial statement, which we'll learn over the next 2 weeks, is a statement of cash flows. So statement of cash flows takes my beginning cash balance and my ending cash balance and tells me, why did the cash level change? So we're going to look at the change in the bucket, right? The water level, did it go up or down during the period? In this example, the water went down, right? So why did it go down? Because we had inflows and outflows from operating activities, investing activities, and financing activities. So again, the tap represents the inflows of cash, and the holes in the bucket at the bottom represent the outflows of cash, right? So statement of cash flows, brace yourselves. We're going to start on that next week. Today I want to give you a little exercise to help you understand the difference between income that shows up on the income statement and cash, right? So the idea of accrual accounting is that we want to record revenues and expenses in the period that they're incurred or that the revenue is earned, whereas cash may come in or out at different times. Okay, so here's an example. If you look in your little handout. First question, has anybody ever been to London? Raise your hands high. Cool city, right? While you were in London, keep your hands up. While you were in London, did anybody go see a play? So at the west end of London, it's kind of like, if you go to New York City, they have Broadway, where they do all kinds of plays, right? Musicals and things like that. If you go to London, if you've never been, you've got to go see a play there. So I've seen Les Mis and Wicked and some other ones in London. And there's kind of a competition. Some people say Broadway's better, some people say London is better. But so your example here, you got a guy, an American, decides he's going to go make some money. So he moves over to London, and he's going to make money buying and selling tickets. So you find a lot of people out there kind of selling tickets on the street for some of those plays. So it says, Jim began a ticket business in London, the London Theatre District, given his ability to identify great profit-making shows. So Jim contributed, and there's an error here. It's pounds. If you go to London, it's not euros, it's pounds, so I apologize. But it says Jim contributed 2,400 pounds of his own personal savings and purchased 30 tickets totaling 2,400. Now this is fall of 2018. You got to buy these tickets way in advance, right? Because they sell out pretty quickly. So he's thinking 2 years in advance. He buys a bunch of tickets. So this is fall 2018. And these shows are going to run during 2019 and 2020. All right, so December of 2019, so pretty much a year later, he sold half of the tickets for what is going on? Kill Siri. All right. So during December 2019, he sells half the tickets for $3,200. And by the way, when first time he gets some cash, he's going to now, because if you think about the original 2,400, where'd it come from? His personal savings account, right? He's investing his own money. He's investing, right? It's kind of like investing in stock in a company. But then the first time he sells tickets, he's going to then pay that money back out to himself to put back in his savings. So think of that kind of like a dividend, right? So the first one's an investment. The second one, he's taking money out on this date right here. And then finally, during 2020, he sells the rest of the tickets for $3,900. All right, so you got the numbers in front of you. What I want you to do is think about what's the income statement going to look like for those 3 years, and what's the cash flow statement, so cash inflows and cash outflows. And you're going to see some differences in timing here. So take just a second in your groups, look through, so you have a little bit of space. So the income statement is just revenues minus expenses equals net income. And the cash flow statement, just do cash inflows minus cash outflows equals net change in cash. Does that make sense? So take a couple minutes, talk about it together, and see what you come up with. Nicholas, let me get you a chair, man. There you go. Sorry. We may have to kind of work with you every day just to get one of these mobile chairs that you can stretch out a little bit. Does that work for you?
Thanks.
All right, guys, let's talk through this together. I want you to understand the difference between earning revenue and receiving cash, and incurring an expense and paying cash. Okay, so a lot of times you've done some work for somebody, you've earned some revenue, but they don't pay you right away, right? We've talked about that before. And sometimes you incur an expense, but you're not going to pay it until later. So the timing may differ between when the revenue or expense is recorded in the income statement and when the cash is actually received or paid. All right, so in this particular example, let's kind of think about the income statement. So during that first year, all he's doing is kind of investing, right? He's going to put some of his personal money into the business. He's going to buy the tickets, but he's not going to sell them till a year later. So in order to earn money in his ticket selling business, how does he actually earn revenue? He's got to sell tickets, right? During that first year, did he sell any tickets at all? 0. So on the income statement, that very first year, he has no revenue because he hasn't sold any tickets. He hasn't incurred any expenses yet either, because the only expense in this business really is cost of goods sold. You can't have cost of goods sold until you sell some tickets, right? So nothing's happening on the income statement in year 0. Was there cash coming in and out? There was. We'll talk about that in just a minute. Okay, in 2019, the first actual year of operations, what does he do? Sells half the tickets, right? Has he earned some revenue? Absolutely. So his sales revenue for that first year is $3,200. What was the cost of those tickets? $1,200. So what's his profit during that year? His profit is £2,000, right? Okay, third year rolls around. He's going to now sell the other half of the tickets, but this time he actually gets a little higher price for them, right? So his revenue is going to be higher. So during the second year, he sells half the tickets, and the sales revenue is $3,900. His cost of goods sold, again, is the same. It's half. It's half of the cost of those tickets, so $1,200. So he makes a little bigger profit during the second year. And if you look at those 3 years in total, his total revenues are $7,100, and his total expenses are $2,400, right? So he makes a profit of $4,700. Now let's think about the cash. First year, was there any cash coming into the business? Think about it. Yes, there was an investment. So it was from an owner situation. He invested from his personal savings, so there was some cash coming in. What did he do with that cash? He paid it out to the ticket sellers when he bought those tickets, right? So during the first year, there's an inflow of $2,400 from his personal savings, but there's also an outflow to buy the tickets, $2,400. So what's the net change in cash? 0, right? Everything that came in went right back out the door. Second year, that's when he starts selling tickets. Is there going to be a cash inflow? Right? So he's going to have $3,200 cash coming in. And is there a cash outflow that year? There is that year, because what does he do with the first cash that comes in? He's going to put it back in his savings, right? So he's basically paying a dividend to himself that year. So during the first year, he has cash coming in, $3,200 from ticket sales. But then he also then takes out $2,400 from the business and puts it back in his personal savings. All right, so the net cash increase that year for the business is $800. Third year, does he sell some more tickets? Absolutely. So he has cash coming in. So cash coming in is going to be $3,900. Is there a cash outflow that year? He doesn't pay any cash out at all that year, right? So he has a 0 cash outflow. So it's all kind of just cash inflow that year. If you look at the 3-year period in total cash in, $9,500, total cash out, $4,800. But so here's the point. Total net income for the 3 years, $4,700. Total cash inflow or increase, $4,700. So over the 3-year period, the cash flows equal the net income, right? But the timing is very, very different. And so that's the point I'm trying to illustrate with this example, is that what happens on your income statement doesn't necessarily reflect what's happening on your cash flow statement, because the timing is off. No, so here's the rule. Let me go to this next slide. I think this is an important concept for you to get. Oh, sorry. There's an extra one here. So this is the book's version of the accounting cycle. And I gave you my version last time. The only difference is I was inserting trial balances, so you can kind of see where those trial balances take place. But same basic idea. All right, this is the idea I want to emphasize. So on the income statement, we use the term to recognize. To recognize simply means to record in the financial statements, right? So we're going to record in the financial statements, so this is what we call accrual accounting. We're going to record revenues when they are earned. So two types of companies. If I'm a service company and I do a service for you, that's the period where I'm going to record the revenue, right? When I've done the work. If I'm a merchandiser or a manufacturer and I'm selling products, in the period I sell the product to you, that's when I've done the work, and so I'm going to record the revenue in that period. So there's kind of two requirements for recognizing revenues. It's the period that you do the work, either performing a service or selling the goods, and when you're reasonably sure that you're going to be able to collect the money. That's when you recognize or record the revenue. So this term recognition simply means, when do you record the revenue? It's going to be the period that you have an inflow of resources, right? The period in which you do the work. Okay, how about expenses? We record expenses in the period that we use the term incurred, when we've incurred the expense. Okay, that's kind of the outflow of resources. So in my depreciation example, I was trying to show you that we're recording depreciation expense, sort of matching it in the same period or allocating over the life of the asset, but matching it with the revenues that it's helping to generate, right? So recording revenues and expenses doesn't necessarily match the cash flows. So there are two terms which you need to become familiar with. One of them is called deferral, and one of them is called accrual. So the next little phase of the chapter is about what we call adjusting entries. So adjusting entries, these are situations where the timing of the cash does not match when you record things in the income statement, right? So a deferral is when the cash precedes the income statement. So we've talked about this before. You guys pay your rent at the beginning of the month, right? So you're paying the cash now, but what does it represent? It's an asset to you, right? You have the right to park in your case, yourself, but if it were a business, you're paying prepaid rent. You have the right to keep your business there in that space for a period of time. So it's an asset. So right now, we're going to have the cash outflow. Later, over time, as the prepaid rent is used up, right, as time passes, we're going to record it as an expense. So as assets are used up, they become expenses. So that's the idea of a deferral. Accruals are situations where the income statement precedes the cash inflows and cash outflows. So for example, if you have employees that work for you, so if they're working for you the week leading up to December 31st, but payday is going to become sometime after the first of the year, when you get to the end of the year, you have to say, look, these employees worked for me, I've incurred an expense, they've done the work already, so I owe them, and so I'm going to go ahead and record the expense in that period, even though I'm not going to pay them until next period, right? That's an example of an accrual. So let me quickly just kind of describe to you, so this is kind of the book's version of what deferrals and accruals are. These next two slides I think are going to be very helpful for you as you think about adjusting entries. All right, so on the revenue side, we can either have deferrals or accruals, right? So in the accrual side, if I do some work for somebody, so I perform a service for you, if I've done the work, I should be able to record the revenue now, right? So I'm going to record the revenue now. You might not pay me till next period. So I'm going to go ahead and accrue it. Okay. Oh, sorry. Let me give you two rules for adjusting entries. Number one, adjusting entries never involve cash. And adjusting entries always involve, get out of here. Sorry, it's covering up the bottom of my screen here. All right, they never involve cash, and they always involve one income statement account and one balance sheet account. Okay, so example on the revenue side of accruals. So I do some work for somebody, so I record the revenue now, and I'm going to record accounts receivable, they'll pay me later. Later, when I collect the cash, I'm going to show an increase in cash and a decrease in accounts receivable. So which one of these two entries would be the adjusting entry? Again, adjusting entries can't involve cash, right? So can this one be the adjusting entry? No. Adjusting entries always include one balance sheet account and one income statement account. So that first entry up there, that's the adjusting entry. We're going to accrue the revenue meaning we're going to record the revenue now, even though we're not going to collect the cash until later. A deferral is the other way around. Somebody pays me now for some work I'm going to do for them in the future. So I collect some cash now, and I have to record. So if I haven't done the work for them yet, I owe them a service, right? So I'm going to record that as what's called unearned revenue, which is a liability. So if I collect cash up front, I owe them a service. I'm going to record that as an obligation. Okay, later, when I do the work, I'll say, okay, now I've earned the revenue, so I'm going to take it out of unearned revenue and record it as revenue. Okay, so now, which one of these meets the definition of the adjusting entry? Can't include cash, so can it be this one? Can't be this one. And it includes always a balance sheet account. This is a balance sheet account and an income statement account. So this one's the adjusting entry. All right, we're going to do the same thing now with the expense side. So this is the revenue side. On the expense side, the accrual means I'm going to record the expense now, even though I haven't paid it yet. Okay, so for example, I record expense and record some liability saying I'll pay for it later. Then down the road, when I pay the cash, I'm going to do what? Get rid of the liability and show the cash outflow. So which one of these two entries could possibly be the adjusting entry? It's got to be the first one, right? No cash, and includes both an income statement and a balance sheet account. How about on the other side, deferrals? You've been doing this for a while. Prepaid rent, for example, prepaid insurance. So you pay the cash now, record the prepaid expense, which is an asset. Later, once that asset is used up as time passes, you're going to show a decrease in the asset and an increase in the expense. So of these two entries, which one is the adjusting entry? The second one, right? So, guys, these two slides are really important in understanding how we do adjusting entries and what they are. All right, so this is kind of going to help you for your homework for next time. All right, let's quickly go through. I've just got a couple of minutes. I want to go through your RA quiz questions for today. So first one, which of the following is a temporary account? Remember we talked about closing entries? What kind of accounts are temporary accounts? So the income statement accounts, revenues and expenses, and one more, dividends, right? So those are the ones that are temporary accounts. So of this list, which one would be a temporary account? Wages expense, right? Very good. Question number 2. Now, guys, I'm a visual person, so I always try to draw T accounts when I'm kind of thinking through a problem. So this will be helpful for you. So it says, as of the beginning of 2016, the company had equipment totaling $900,000. So there's my equipment account. It's an asset, has a debit balance of $900,000, which is depreciated $75,000 per year. So basically, we want to show this asset going down, right? Going down in value by $75,000 per year. Well, so you're going to learn more about this later, but we actually set up kind of a companion account that goes with the equipment account. It's called a contra asset account, called accumulated depreciation. So each year, as the asset declines in value, we're trying to show that decline, we record a credit to accumulated depreciation. So the sum of these two accounts, right? We paid $900,000 for it, but we've depreciated at $75,000. What's it worth after 1 year? The sum of those two accounts is $825,000, right? The net value of that asset is $825,000. So the journal entry then, to record this accumulated depreciation, we debit depreciation expense. So let me use this term again. As an asset is used up, it becomes an expense, right? So we have a long-term asset, equipment. It's sort of being used up over time, and so we're going to show a decrease in the value of the asset with this companion account here, right? So we show a decrease in the value of the asset by showing it going down by $75,000, and we're showing it as an increase in depreciation expense. So that would be the journal entry to record depreciation expense. So the correct answer here is a debit to depreciation expense. Okay, these kind of ideas will become more familiar to you as we work more examples. Next one, it says this company received $2,500 from a tenant on December 1st for 5 more months' rent of an office. Okay, so we've received cash today. So the original journal entry would be what? Increase cash with a debit. But in this, remember prepaid rent, if we're the one paying it, it's an asset, right? What if we're the landlord now? And we're renting out the office space to somebody else. They pay us cash in advance. What do we have now? We have an obligation. We owe them something. We owe them the right to park their business there for the next several months, right? For the next 5 months. So the original entry is increase cash and increase unearned revenue, which is a liability account. All right. Then it says this was December 1st through April. It's supposed to be December, January, February, March, April, right? They've paid 5 months rent. So they pay on January 1st. We get to December 31st. It's the end of the year. Do we need to make an adjustment here? Right. So in other words, they've used up 1 month of their prepaid rent on their side. On our side, we've earned 1 month of that unearned revenue that they paid us. So this is going to go down by 1/5. So unearned revenue will be decreasing, debit 500. And it used to be an obligation, a liability, but now we've done the service, right? We've done the work for them. And so we're going to record it as rent revenue. Okay, so that's the adjusting entry. So the correct answer would be debit unearned rent income or rent revenue and credit rent revenue. Number 4. So these are kind of hard, guys. That's what I'm saying. We have to really work hard to get these adjusting entries. Next one. Sorry. Oh, sorry. Going too fast here. During their first year, Smith & Associates bought $16,000 of office supplies for their CPA firm. So I'm just assuming paid cash and debited supplies, right? So that's the original entry. When adjusting, what adjusting entry would Smith & Associates make if 4,000 of supplies were on hand at the year's end? So we started with 16,000. We do a physical count of the supplies at the end of the year. We want to show a balance of 4,000. What adjustment do we need to make to this supplies account in order to get it from 16, which was the original amount we paid, down to the correct ending balance of 4,000? How much does it have to go down by? Yeah, we got to decrease it, so we got to put a number on this side, on the credit side, to decrease supplies by 12,000. So the adjustment then, credit supplies, 12,000. Now, this is an asset, right? We said as assets are used up, they become expenses. What kind of expense would we call this? Supplies expense, right? So we're going to record a debit to the supplies expense account. So our correct answer then would be here, debit supplies expense, credit supplies. Okay, again, T accounts make it much easier to figure out these adjusting entries. All right, last one. It says at the end of the first month of operations, Bradley Company's accountant prepared the following financial statements. So these are sort of the unadjusted balances, the ending balances before adjustment, right? And then they're going to make some adjustments. So they have to record some depreciation of 1,000. That'll be depreciation expense. Some service revenue is being earned, 1,500. So we've earned the revenue but not yet collected the cash. And then we've got some wages. So our employees have done work for us. So we've incurred wages expense, but we've not yet paid for it, right? So what adjustments will we make? So our assets then, we started with 60,000, and they're going to go down by the amount of depreciation expense, and they're going to go up. We're going to have an accounts receivable for the revenues we've earned. On the liability side, we started off with 20,000, and we've incurred a liability for 250 for the employees that we owe for their wages. Stockholders' equity, if you kind of think about it, we close out net income into retained earnings, right? So net income prior to this was 9,000 plus the $1,000, minus the $1,000 of depreciation expense plus the service revenue we've earned minus the wages expense, right? So our net income is 9,250. That gets added into our retained earnings, and so that will give us our final balance there. All right, guys. The final example of the day, look at the bottom of your handout. All right. These all represent adjusting entries that you would make at the end of the year. And so we're going to go through each of these adjusting entries. I'm going to try to help you visualize how to use T accounts for most of them so you can kind of see what's happening. Okay, so the first one says weekly employees' salaries for a 5-day work week totaled $1,800, and it's payable on Fridays. So here's the problem. December 31st falls on a Tuesday, right? They work Monday and Tuesday. It's December 31st. Bye, have a nice New Year's Eve. And they're going to come back, January 2nd or whatever. We'll pay them on Friday, right? So as of December 31st, do we owe them something? Absolutely. We owe them for 2 days' wages. So we need to record wages expense because we've incurred the expense, and wages payable. How much is it? So if it's $1,800 per week, that's 5 days. They've worked how many days? 2. So 2/5 of that, if you were to multiply it by 2/5, then we're going to owe them $720. So we go ahead and record a debit to supplies expense. We've incurred the expense, and a credit to salaries payable. So did I say supplies? Salaries expense and credit salaries payable. All right, number 2. It says Quick Print has $20,000 of notes payable outstanding at December 31st. Interest is $200 has been incurred for these notes by December 31st. So we've not yet paid the interest, but we owe it, right? So over time, what happens with interest? It just accumulates over time. So we have to record what kind of expense here? Interest expense. But have we paid it yet? No. So we're going to accrue the expense and record interest payable. So we debit interest expense, credit interest payable. Number 3, during December, Quick Print provided $900 of print services to clients who will be billed on January 2nd. So we perform services, right? What's happened during December? We did some work. So we have done what? Earned some revenue. But did we collect the cash yet? So we're going to show an accounts receivable, right? So we're going to go ahead and record the revenue. We increase revenues by putting the number on the credit side. So we record sales revenue, and we're going to is it a service or a sale? I don't know. I don't know if it's a service or a sale, but whatever that is, we're going to record the revenue and debit accounts receivable. Number 4, it's helpful to use T accounts. So here we go. It says number 4, starting December 1st, all maintenance work on Quick Print's equipment is handled by Richardson Repair Company under an agreement whereby Quick Print pays a fixed monthly charge of $400. Quick Print paid 6 months service charge in advance on December 1st, debiting prepaid maintenance. So if you guys ever been to like a Kinko's or Belgine's copy center down on Main Street and on Broad Street? So what happens is these copy centers, they have to pay people to come in and maintain their copy machines, right? So that's kind of what they did here. They actually paid for how many months was it? 6 months. They paid 6 months of maintenance in advance, so it would be an asset to them, right? So when they originally recorded it, they paid the cash, right? So cash went out, and they recorded this asset called prepaid maintenance. It's kind of analogous to prepaid rent or prepaid insurance, something like that. So each month that goes by, 2,400 divided by 6 is how much? $400 per month, right? So as each month passes, they're going to use up 1/6 of that asset. Okay, so at the end of December, 1 month has gone by, right? This is an asset. So as this asset is used up, it becomes an expense. What kind of expense would it be? Maintenance expense, right? So we're going to show a decrease to prepaid maintenance of 400. It's been used up. And we're going to show that then as an increase to maintenance expense. Does that make sense to everybody? All right, so we'll post this for you later. T accounts are helpful. So we're going to debit maintenance expense and credit prepaid maintenance. All right, likewise, number 5, I think it's useful to look at T accounts. So number 5 says the firm paid $900 cash, debiting prepaid advertising on December 15th for a series of radio commercials to run during December and January. 1/3 of the commercials have been aired by December 31st. So again, the original entry was what? Did cash come in or out? We paid cash, so cash went out, credit, and what did we record it as? It's an asset, prepaid advertising, right? So the original journal entry looked like this. Decrease cash, debit prepaid advertising. All right, so during the month of December, 1/3 of those commercials have now aired on the radio, and so that asset has been used up, right? So we're going to show a decrease to prepaid advertising by putting the number on the credit side. What's 1/3 of 900? 300. And then as an asset is used up, it becomes an expense. What kind of expense is this? Advertising expense, right? So we're going to show a decrease in prepaid advertising and a debit to advertising expense. So that's going to be our adjusting entry. Debit advertising expense, credit prepaid advertising. Number 6, it says, a customer paid $600 in advance for a custom print order. At December 31st, Quick Print had delivered 1/2 of the order. Now guys, think about this. It was easy for us to think of prepaid expenses that we paid, right? This is somebody paying us now for some services. So if we collect cash today, and I haven't done the work yet, what does it represent to me? It's a liability, right? It's an obligation. So the original entry then would look like this. Increase cash, debit, credit unearned revenue. Guys, I got to keep emphasizing this. You got to hear this term a lot of times. Just because you see the term revenue doesn't mean it shows up on the income statement, right? Unearned revenue means I owe them some services, or I owe them some products. So this is going to be a liability account. It goes in the current liability section. All right, that's the original entry. Now, how much of this has been, how much of the work have we done by December 31st? Half. So in other words, half of this obligation has now been sort of satisfied. So I want to decrease unearned revenue by how much? 300. So I'm going to show a debit to unearned revenue for 300. Now this is kind of the opposite of what we said before. This is a liability. We've now done the work, and so we have earned some revenue. So this is going to become, so unearned revenue becomes earned revenue, right? So we're going to record this as sales revenue. This actually maybe a better description is if we've done print services, I don't know if you want to think of it as service revenue, or we actually gave them paper. We printed stuff up, right? So I guess we could think of it as a product. So in this case, debit unearned revenue, credit sales revenue. Okay, last two, we're almost out of time here. So number 7, it says Quick Print invested $5,000 cash in securities on December 1st. Earned interest of $38. So I bought some stock in another company. It's an investment. And because of that investment, I've earned some interest, right? So if I've earned some interest revenue, I'm going to credit interest revenue. Have I received the cash yet? No, so they owe it to me, so I would actually record that as a receivable. So I'm going to actually debit interest receivable and credit interest income or interest revenue. Last one, number 8. It says annual depreciation on the firm's equipment is $21.75. So as of the end of the year, we just got to record this depreciation expense. I showed you in a previous example what this looks like. We're going to increase depreciation expense with a debit, and we're going to decrease the asset. But how do we decrease the asset? We set up that companion account called accumulated depreciation. Okay, so if you remember, we had equipment, we have accumulated depreciation. So the entry is we're going to put it as a credit to accumulated depreciation and a debit to depreciation expense. Again, let me just help you understand. The concept is, yes, the asset is being used up, but instead of crediting the asset itself, we just record it at its original cost and show the decrease in that adjunct, that companion account, that contra account. All right, so this would be the journal entry. All right, guys. So for next time, well, for tonight at midnight, what do you have to do? Comprehensive project. And for next Monday, you've got the homework on sort of adjusting entries and closing entries. Thank you very much. We'll see you all next time.